Good evening, everyone. Good evening, leaders, and welcome to this evening's event brought to you by BMF Sandton. We'll be discussing managing and protecting your finances. I am Tobega Hadebe. I'm the Head of Education and Development for BMF Sandton. Today, we have two panelists, Mr. Sizwe Buthelezi and Mr. Leroy Monetsi. Sizwe Buthelezi is a financial planning consultant. He started off his career in 2013 at F&B, then he went to ABSA Advisory before coming to Alexander Forbes. Sizwe is an experienced financial advisor with demonstrated history in working within the financial industry. He's a finance professional who holds qualifications in finance and estate planning. He has worked for financial institutions such as F&B and ABSA and is currently employed, as mentioned, by Alexander Forbes as their financial planning consultant, where he advises individual clients on their retirement and investment planning. His interests are to promote financial literacy and financial wellness among his friends, family, and clients. Welcome, Sizwe, and thank you for making the time to talk to us tonight.
Thank you so much, Tobega. Great to be here. Thank you.
Welcome. Also on tonight's webinar, we have Mr. Leroy Monetsi, who is the Chief Operating Officer for the Consulting Division at Alexander Forbes. He's a seasoned corporate professional. Leroy has a diverse understanding of business and leadership gained through his experience across a range of industries and geographies. And although his career is now mainly based in financial services, Leroy is an adaptive and a versatile leader who is passionate about solving problems, optimizing performance, and leading people. His career spans a little over 25 years. Leroy has held executive roles with a number of prominent organizations, including being Chief Operating Officer for ABSA Life, Executive for Africa and New Markets for Mutual and Federal, which is now known as Old Mutual Insure. He's been an executive head for business insurance at Tillishaw Investment Holdings, a managing director for Standard Trust Limited, a subsidiary of Standard Bank Group, and is currently with Alexander Forbes as their Chief Operating Officer for their consulting division. How impressive is that, guys? Leroy's role at Alexander Forbes takes the responsibility of enabling and supporting all client-facing business units with the implementation of their respective strategies. This involves overseeing the delivery of a range of core enabling functions, as well as providing an interface with a range of internal and external stakeholders. Key functions which fall under his purview include risk and compliance, technology, data and information management, customer experience, project management, and operational support. Leroy also heads up the Diversity and Inclusion Forum, which has a mandate to help the organization improve employment equity and foster a culture of fairness, transparency, and inclusiveness. And that is something that we definitely like to hear here at BMF. In his spare time, Jesus, man, does so much. Leroy has been a guest lecturer in operations management at Wits Business School since 2020. In addition, he has started building a coaching practice, which is focused on personal effectiveness. With an accounting degree as his foundation, Leroy has an MBA in strategic management and a graduate diploma in industrial engineering from the University of Wits. He is motivated and ambitious, clearly, thrives on diversity and change, and is committed to making a meaningful contribution to the success of the African continent. Mr. Monetsi, thank you for being part of this conversation and welcome.
Thank you. I didn't realize my intro would be as long and as flattering, but really appreciate it, and it's a pleasure to be here.
Welcome. Well, we're going to start with you, Mr. Monetsi. It seems like with your range of experience, like you do so much, and now I'm just bringing you here to something so simple. How do you then simplify to us, how we can manage our personal finances?
Thank you, and it's definitely a privilege to be here to share and engage. I think part of the journey with such a topic is to make sure that it's as engaging and interactive as possible, because no one has all the answers. And in part, that's why I made sure I had my more knowledgeable colleague in Ubabu Butelezi to make sure that he could cover the more technical bits, or at least the more chunky bits. And I would look to focus on probably the more softer side and the more general elements of managing and protecting your finances. I think in a nutshell, the opportunity that we have as individuals and as a country is to progressively improve our understanding of the financial system. The financial system, which dates back many, many centuries, started with elements such as barter trading and some of the more basic elements of you transferring monetary value using certain objects. Now it is a far more complex and complicated system, but no doubt there is an opportunity for all of us to leverage what that system provides to us as opportunities, learn and take advantage of that to ensure that the financial well-being, not just of ourselves, but hopefully for our families and for generations to come, is improved going forward. So I think what we've put together is a fairly extensive slide deck, which between myself and Lucy's, where we will work through and hopefully stimulate some thinking and engage any questions or discussions towards the end. And no doubt as we go along, perhaps we would also look to address any questions that come through in the chat, but really for us to try and isolate specific points to emphasize and also simplify where we can certain things that may tend to be quite complex or above our pay grade, so to speak.
All right, take it away.
All right, so I'm just going to request control so that I can move the slides from my side. But I think the main gist of what we have in our topic for this evening really has to do with managing money. And the big challenge that we all face when it comes to managing money is to understand that as grown-ups, we have far bigger responsibilities than we had when we were not grown-ups. As a child, life was very simple. It was easy to just say, I'm hungry, and food would be provided. Your shoes are torn, and your shoes would be repaired, or you'd get a new pair. And yeah, for those who are in more privileged circumstances, they got to enjoy the fruits and the benefits of their parents' labor or other mechanisms that contributed to their financial well-being. The difficulties that I'm sure all of us can attest to are that as a grown-up or as an adult, you then realize that you need to be firstly a lot more focused, but ultimately a lot more responsible with how you manage and spend your financial resources. The tag that we've put on the screen to say, don't grow up, it's a trap, is really a bit of a comical play on the fact that it doesn't get easier as you grow up. When we were younger, we thought life would be so much better, so much more exciting when I'm working and I can buy cars or I can travel. But the reality is it comes with significantly more responsibilities. And as it is said in Spider-Man, with great power comes great responsibility. And so in this grown-up life of ours, it's so much more important to understand how we influence our financial livelihood and ultimately the financial well-being of ourselves, our immediate family, and no doubt the generations that are to come. So it all, in many ways, boils down to choices. And we make choices all the time. Choices really influence a lot of our success and our failure. Our aspirations and our goals, in many cases, are informed by what we imagine and what we dream. But to be able to dream and to achieve those dreams or whatever visions we may have, it is important for us to be organized and, in simple terms, to be planned. Have plans in place to help translate what you imagine to a reality. And yes, sometimes those choices are as simple as whether to eat more confectionery or whether to go to the gym and work out. But in many cases, some of that is much bigger in terms of whether to buy or rent, whether to lease or buy for cash, or whether to put away money or to spend. And a lot of that we will try and unpack in some detail, because that's where a lot of what we see from an experience point of view, a lot of it does boil down to the choices that people make, supported or influenced by the habits that people have formed over time. And that either supports our ability to achieve or realize our dreams, or compromise our ability to achieve or realize those dreams. So what I've been able to do in the short time that I've been a grown-up, I've realized that the power of decisions also talks to our ability to take on information. And in many cases, we realize that what your parents used to try and teach you when you were a terrible teenager or tormentous teenager who was moody and grumpy and didn't want to listen, comes back to bite you, in that you may have missed the opportunity to learn certain things. But no doubt it's never too late to learn from your mistakes and to start building from there. There's a famous Chinese proverb which says the best time to plant a tree is 20 years ago, and the next best time is today. So with financial literacy and understanding how to manage your money and to protect your money, it may seem like it's too late in certain respects, but it's important to then take on the information at whatever point in time and improve your ability to manage money where you are. Very simplistically, it does talk to managing those habits, ideally reducing your exposure to bad habits or habits that compromise your success, and building on those that are more productive and take you forward either to being a better individual holistically, or more specifically to achieve your financial goals. Personally, I've had the opportunity to read through this book called Atomic Habits by James Clear, and some of the lessons in there really proved to be very useful in my own personal effectiveness, but quite importantly, in my ability to manage and plan around how I spend my financial resources. And I thought it would be useful to share that as we set the scene for the conversation that we would have this evening. So before I hand over to Usizwe, our first subtopic for this evening is budgeting and planning. And many of you would know that across the range of tools and techniques that are available to us, budgeting and planning is quite central and foundational. Organizations use it to run how they plan their resources and how they plan to achieve their strategies. As individuals, similarly, it's important to then align your goals, your visions, with how you plan to spend your financial resources. And what we've realized quite often is too many people spend money that they haven't quite earned as yet. And quite often they spend that money on things they don't need. And too often they spend it on trying to impress people who either don't know them, in some cases that they don't even like, and may not even care. And that ends up bringing us into situations where we find ourselves under significant financial pressure or stress, which is avoidable if we're able to simply focus and probably adopt a more balanced and deliberate approach to managing our finances. And my colleague Sizwe will probably expand a lot more of that when we unpack some of the other tools or techniques that are available to us. But from a financial planning point of view, one of the core and most basic tools that's available to us is a budget. What that does for us is it gives you a view of what's going on. Similarly, in a car, when you're driving a car, you've got a dashboard, you've got a windscreen. It helps you to see what's up in front of you, and the dashboard specifically helps you to see what's going on in your engine or in and around you. More recent cars will have fully embedded navigation systems that again help you to navigate your way forward. And the analogy that we wanted to draw here is that using a dashboard of sorts, or using your budget or your financial plan, helps to guide the decisions that you take along life's journey. And no questions or no prizes really for what my favorite car is. given this picture that's on the screen in front of us. There are many types of budgets that you can consider. For me, I've got a brother who's an actuary or a statistician by profession, and he can come up with very fancy analytical tools for me to use to plan how I spend the money that I earn, and it will have graphs and pictures and animations. But on the right side of the screen, you will see that even the most basic or most simplest of forms of a spreadsheet really is valuable and useful in helping you to plan, because again, it's about giving visibility to where your money is coming and how your money is going. And ultimately, being able to balance that out just needs you to make sure that there is visibility. Some of you will be familiar with the quotes from a personal effectiveness point of view, which point to the benefit of writing things down. Similarly, from a budgeting point of view, being able to put a plan on paper or onto some sort of a tool helps to manage the financial resources that you have a lot better and a lot more consistently over time. Nowadays, we've got apps that we can find on our banking apps. Most of the banks that we have give you such tools. Even insurance companies, to an extent, try and give access to such apps for you to be able to leverage the power of computing technology to help you again plan better, schedule things better, and understand what your financial situation is over time. So I think really as an initial tool, budgeting and budgeting tools help us to plan. They help us to see what's coming down the line or where we may have shortcomings, and help us to make decisions to either borrow, shift things out, reschedule certain priorities that we may have, or in some cases simply say no. Because in our experience as grown-ups, we realize that sometimes the fact that we continue to say yes to certain things might we find ourselves in difficult situations because we didn't avoid avoidable circumstances where we could have simply said no. But ultimately, to translate those plans and ideas that we have, it's so important for us to package it in a way that you can monitor and manage it on an ongoing basis, and then progressively take the specific actions that you may have in mind. I'll now hand you back to Usizwe to take us through the next topic that we have for discussion.
Okay, while you gentlemen are doing the technicalities of handing over in the presentation, I just wanted to just add in a comment for myself. I've been using budgeting tools since I was doing my articles, legal articles, and I use the exact same tools since. And just wanting to encourage is the consistency, because as you're consistent over time, you get to see where you spend your money. And back then, what was eating my money was airtime. And it seems nominal, but like back then I had to learn, oh, okay, I need to cut down on airtime, and that helped in the long run. And just with your point of saying we say yes all the time, it links to what you were talking about, where we spend money mainly to impress people. But if we actually shift the way we spend money towards our goals, your no has power and purpose. All right, over to you, Sizwe.
All right. Thanks, Thobeka. Thanks, Leroy. Good evening, leaders. Hope everyone is well. So the subtopic that I'll be discussing on is the management of debt. We cannot talk about personal finance as well as managing our finance without speaking about debt, the effects of debt, as well as the managing of debt. So what is debt? So the simplified definition of that, debt is simply spending your money before you earn it. So we do have good debt as well as bad debt. So not all debt is good and not all debt is bad. If debt is used properly, it can be a tool or an instrument that can be used to grow our personal asset base, as well as our long-term financial plans, as well as financial goals. So when it comes to debt, it's not really the great temptations that ruin us. It's the little temptations that we give into. Let me spend here and there, and before we know it, we find ourselves in high levels of debt that isn't manageable. So as I'd mentioned, there is good debt, and normally would say good debt is your long-term debt, which is your home loans, your study loans, as well as your motor vehicle financing. That debt would be regarded as your short-term debt, your credit card, clothing accounts, hire purchase, and your micro lender accounts. So normally the short debt is used by individual to fund a level of lifestyle. The long-term debt would be used to acquire an asset that will improve one's personal finance, one's personal asset base, as well as their long-term financial goals. Just some interesting facts to consider.
Can I take you back to the previous slide? So you're now showing us examples of good debt and bad debt. However, I've heard, you need to build a credit record, and some of the things that you have there would be some of the advices that perhaps you've heard in the street. Just get a clothing account or just get a small credit card, but you've labeled it as bad debt. Can you just maybe just touch on, I don't know if you're still going to get there, just touch on with us, can that bad debt ever be good debt? And do we really need it to build a good credit rating?
All right. Yeah, thank you for that question. So definitely the way the system is designed is that in order for financial institution to grant you long-term debt, that want you to take up what we call short-term debt. So short-term debt, if managed properly, is not bad. The only thing that we do see currently is that individuals or consumers make use of the short-term debt to fund their lifestyle, and that actually spirals out of management, and they are unable to manage that short-term debt. So a typical example would be, for instance, if one were to want to build a healthy credit history, we would encourage, or I would encourage them to take up a credit card. But very important is that credit card limit needs to be at a point where it's manageable. And another thing is that most financial institutions, when they grant you that credit card, they've got that 55 days interest-free term, whereby if you use that credit card and you paid within that 55 days, there isn't any interest charge on that debt. So it can be used as a mechanism to have a healthy credit score, and that can be used then to acquire the long-term good debt. All right. I'm not sure if that answers you.
It does. And then we had a question from Frank. I just want to also side note mention, I have noted the questions in the Q&A and we will get there. But I see Mr. Monetsi has responded on that. He was asking why there was a question mark on motor vehicle. So Mr. Monetsi said perhaps it depends on the type of car, example VW, but he's kidding. It's because vehicles are depreciating assets and therefore less favorable in the context of your long-term financial well-being. Okay, you can move on, Frank. Sorry, you can move on, Sizwe.
All right, thanks. So what I've put up here is just some facts to consider when it comes to South Africans and credit. We have about 12.8 million citizens in South Africa who've got good credit ratings or credit scores. And we have 10.5 million with impaired financial records. So what this means is that these individuals in this section here would have records where they cannot acquire further debt. And if they do acquire further debt, it becomes very expensive. These people are now what we call blacklisted. And once you're in that space, in terms of acquiring debt or the ability to take on new debt, it becomes virtually impossible. We have then about 348,000 active credit consumer under debt review. So these are now people who are unable to meet their debt obligations, and they've approached a debt review specialist to assist them with coming up with payment plans, as well as arranging with financial institutions to try and get rid of that debt. Another fact to consider, at the end of 2019, according to the National Credit Regulator, about 3/4 of consumers' income was used to pay creditors. So that is quite high. So what that means is that only 25% of one's income is then used as living expenses, whilst the 75% is then used by households to service debts. Ideally, 30% of one's income should be used to servicing of debt. And the main reason why we're seeing high levels of debt is because majority of the people are borrowing money to fund a lifestyle. Another fact from the National Credit Regulator is that the young working population, they are drowning in debt. And the main reasons for that is due to peer pressure, ease of access to credit. So when one opens their banking app, you'd normally find that you get a pop-up which says you qualify for a certain amount of amount in personal loan or a credit card or anything like that, as well as the desire to buy a certain status with the debt. So that is the main reasons why we're seeing the young population that is working drowning in debt. We have about 56% of homeowners who are struggling to pay off their home loans, and 58% of consumers are struggling to pay their credit cards. So strategies to deal with debt. One would be to list all your debt accounts with the amounts that are outstanding, record the interest rate of each account, pay the debt with the highest interest rate first, pay additional monies into your debt account. That reduces the term, and that also reduces the interest that you pay on that debt. If it's possible, also try and get someone who you can assign to support you in paying off that debt, and identify and prioritize paying off your debt as soon as possible. Be specific. Ask yourself the following practical questions. What debt pose the biggest threats? How do you deal with your creditors? What are your opinions? What will you do if you become blacklisted? Is there a sensible level of debt that you can take on? If you want to take on new debt, it's very important that you distinguish between the must-have and the nice-to-have. This mindset will help you in saving a lot of money, whereby if it's not really necessary for you to take up the debt, rather save for it, rather save money and then buy that asset in cash. All right, so that is all on debt management. I will then hand over to my colleague, Leroy, to take us through the role of insurance.
Okay, as you are doing that, Sizwe, just for me, when you first of all, the ideally 30% of your income, when clients come to you, I just would like to know, like a round figure, like realistically, how many people are actually in a position where they're already only putting 30% towards their debt? Is that the normal person, or the clients that come to you, is it still a journey to walk towards to that 30%?
Yeah, definitely. It is a journey towards that 30%. You'd find that when clients do come to me, they would be part of that 75% that is using their income to service their debts. So we then have that ongoing financial advice as well as financial coaching to try and bring those debt levels to the desirable level of 30%.
Okay, so it's a journey. It definitely is a journey.
It is a journey.
Yeah. Another thing you mentioned was, which was my first personally, is the recording the interest rate of each debt amount and then paying the highest interest rate. So I found it interesting. I think we generally tend to gravitate to pay off the largest amount first. Yet you're saying so are you saying it's not about the amount, it's about the interest rate, to focus on the interest rate?
Correct.
And why is that?
So the main reason why the interest rate, it would be because the highest interest rate, that would, depending on the capital that you've borrowed, that would be taking a chunk of your income. So you want to settle that as soon as possible so that whatever income is then available, you can then channel it towards the cheaper debt and try to settle that as soon as possible as well.
Okay, one last before we move over to Leroy. Nogotula raised something that is an interesting thought in the group. She has asked, is it perhaps that salaries are too low versus the needs? And shortly after, you spoke about distinguishing between the wants and the needs. Within the working class, that's someone that has started working and is, moving the way up. Is it that salaries are too low, or our needs are actually wants?
I would say it's a combination of the two. What I normally encourage is for people to live within their means, within their means, not to take up additional debt to fund a certain lifestyle that they cannot afford. So if you cannot afford a certain lifestyle, it's better to scale down, live within your income and means.
Okay, all right. Before I touch on the other comments, Mr. Leroy, over to you.
Thanks, and perhaps to add on to what Sizwe was saying, the living within your means is it's a delicate one because it's subjective, and you will find that certain people who may have significantly more financial means, their personalities allow them to live comfortably within their means, maybe because of just the fact that they are not as inclined to be as flashy or as extravagant in certain ways. But no doubt, I think at a national level, there's a big debate around income parity, and inequality is one of our biggest challenges. But I think using that conversation as an excuse to get into debt is only at your own peril. I think what's more important is to still then work within what's in your control. And to the extent that you might find yourself in trouble, it might be that you need to seek help. And that's where professionals like Sizwe and other consultants at Alexander Forbes or at other financial institutions may be able to assist you to work through some of those challenges. But no doubt, these are real issues that we all face. And everybody's situation is unique, and hence the opportunity to learn from each other. So very quickly, moving on to insurance, earlier on, I touched on how the financial system has evolved over the years. The opportunity that we have in understanding how the financial system works gives rise to us then leveraging certain instruments like debt. So to the extent that we have a better understanding of good debt and bad debt, and I think in the chat group, there were comments from a couple of people around how you manage that debt, because while it might be bad debt, but in an emergency, it might be critical for you to use that to get out of an emergency situation. But broadly speaking, there are also other mechanisms that are within the financial system that someone can leverage, not just to manage your ongoing financial needs, but quite importantly, to protect your financial well-being. And we at Alexander Forbes, I think strategically, we have shifted away from insurance in particular, but no doubt as people who are involved in the industry, we do have an understanding and we contribute to how individuals can be supported to make better decisions and ultimately secure their financial well-being. And insurance is one of those key mechanisms. I won't go through all the different types in elaborate detail, but quite importantly, I think the discussion that I would like us to focus on is two-pronged. Firstly, it's in and around protecting what you have in the now. So there are those financial instruments, or let's call them insurance instruments or insurance products that are designed to protect what you have now. And that might be in terms of the assets that you have. And generally that's in the general insurance space or homeowners insurance or short-term insurance, because it protects the assets or responsibilities that you have in the short run. Long-term insurance, on the other hand, then has a bias towards life and your individual existence. So to the extent that you have simple life products like funeral cover and death or disability type insurance products, you then range from there to the far side where you look at actual taking life cover, where in the event of death happening, there is a payout to hopefully contribute to extinguishing your debt and setting your family back on the track that you would have likely have been should you have continued to live. And all of those dynamics point to a question which I would like to talk generally. And if I generalize, it's not one of my favorite things, but if you look at our generation as Black managers or Black leaders, we are a generation that is probably a lot more exposed to these tools and products compared to our forefathers and mothers. So if our grandfathers and grandmothers had had a heightened sense or comparably heightened sense of financial literacy, can you imagine where we would be if they had been able to invest in more robust insurance products back then, either to deal with sudden eventualities like a car accident or the burning down of a property, or just to have life cover so that in the unfortunate reality that life happens and they do pass on, their debts are extinguished and the next generation is not inheriting debt, or they're able to leave assets to their heirs, rather than unfortunate circumstances where people end up inheriting very difficult financial circumstances, and those tend to then get passed from generation to generation. And I think the main thrust of the point I wanted to make here is that in terms of insurance, while it is generally seen as a grudge purchase, because in your mind, you might rationalize to say, well, statistically, I'm not going to have an accident, or my house is not going to burn down, or I'm still young, I'm not going to die soon, I'm very healthy. It's so important, again, in understanding your responsibility as a grown-up, that there are decisions which you need to make, which might not be sexy or cool, but are there to make sure that you're able to then meet your obligations and set a platform for a better future for the generations to come. And what we find across the spectrum of insurance products, be it from a medical aid or health insurance point of view, to the more risk associated with property, such as homeowners insurance or the insurance on your car, it's so important to understand what those products can do for you. And then again, with living within your means, you prioritize making sure you can protect what you have, because in the unfortunate eventuality that something does go wrong, insurance is a useful tool to have invested in, because it does help you to protect your financial well-being in those situations. I worked for Standard Trust a few years ago, and one of the things that we realized back then was that a lot of people didn't understand how complicated it is to die. There's a lot of tax implications that come into play when you die. There's a lot of legalistic implications. And one of the simple things that you can use to manage that is a will. And having a will helps to outline your wishes in the event that something does happen. And there are two things that are guaranteed in life: death and taxes. And if you have a will, it simplifies the process of managing your situation, and especially for those who survive you, whether it's your spouse and your children or your siblings or otherwise, their ability to manage your situation is by far improved by you having a will. And in most cases, a will is free. The banks give them out for free. Legal firms generally support you and help you to get a will in place for free. You can also go to a simple place like P&A or CNA and get a will done on your own with the assistance of someone who may know better. But as a simple tool to help you manage and protect your finances, a will is something that we unfortunately drastically underestimate, and it leads to a lot of complexity and challenges down the line. And I think it's one of those things that we need to consider again in our responsibilities as grown-ups, in that it's not always about how much money we make and how much money we're able to show that we've made, but ultimately it's about balancing how we get that money to work for us, and then how we protect that money so that it is able to support the generations that come after us. And I've just put a quote from Robert Kiyosaki on the screen, who is known for the book that he wrote, Rich Dad, Poor Dad, but it really drives the point home around being able to understand how you manage your current circumstances and protect the opportunity for the future circumstances. And insurance is just one of those mechanisms within the financial system that you can leverage in that regard.
Yeah, just a comment there. That quote certainly does speak to me. When you speak about the eventualities, it's even things of, I mean, our power as young working people is the ability to make an income. So for me, like with many other people, when I got retrenched, I was thankful for having had for saying no to a lot of wants, and that was able to sustain me for almost a year, simply because I was able to just make that decision and just say no. Even that back then it was saying no to coffees, something as simple as a cup of coffee. Like even I would just say, no, I can't, but you can come visit me for a cup of tea. But like eating out was a no for me, because like you're mentioning, anything can happen in this journey. We always think it's going to be the worst of worst. Like we think we're immortal, maybe death or disability. Sometimes it can be something as simple as retrenchment. Yeah.
Yep. Absolutely. Back to you, Sizwe.
All right, thanks, Leroy.
Sorry, Leroy, before we move over to Sizwe, in that case, I just want to ask, there was a question on whether income protection insurance products are worthwhile.
I think my simple response is most insurance products are worthwhile. So whether it's income protection, disability cover, life cover. Ultimately, what most insurance is designed to do is to help manage the unforeseen eventualities. So while income protection is a specific product, is focused on protecting your income, as you just highlighted, Thobeka, you didn't plan to get retrenched. And by having income protection, you were able to mitigate the impact of that circumstance that befell you. And so across the spectrum of insurance products, which I think in our generation and in our time, there is such a vast range where, again, you would need to consult with people in the profession, financial planners like Sizwe, who can then help you to navigate how to optimize those products. Because in some cases, there's a bit of a product push where you may find yourself over-insured in certain respects, but with the support and the understanding of great financial planners like those who you find at Alexander Forbes, hopefully you'll be able to make better decisions to manage that, and then perhaps make a decision around whether it is worthwhile in your situation or not. And therefore, I think the short answer is most insurance products are absolutely worthwhile, but you need to then understand those in the context of your situation.
Okay. Kotatso is asking, what is the function of loan insurances and what point do these insurances become effective? I will just touch on that. As the example that I had used, one of the other tools that I'd had was loan insurances. And while I was retrenched, that afforded me 6 to 12 months of grace while I could not earn an income. And then as we hand over to you, Sizwe, there was a question that was, I believe it was from Frank. Which debt is better, prime linked or fixed in this economic climate?
Sizwe, I think you're better placed to comment on that one.
Yeah. So I would still say the prime linked rate, it's still cheaper to service as opposed to the fixed interest rate. So in most cases, financial institution would put a premium on the fixed interest rate due to the fact that the risk is now upon them to ensure that the service costs are fixed over that period of time over the loan term. So the prime linked interest rate is still quite cheap to service as opposed to the fixed interest rate. All right. Back to savings and investments. Okay. All right. So savings and investments. Why do we need to save and why do we need to invest? By saving and investment, we are allowing our monies to work for us as opposed to working for our money. By saving and investing, we are allowing these monies to help us in the future with regards to retirement planning, with regards to perhaps we've got children that need to go to university, so we can use these investments to pay for those university fees. And we can also use the savings and investments to fund, to reach our personal financial goals. So an interesting question that I normally ask most of my clients is that, what if you're to lose a job, become disabled, or even to pass away? How will you provide for your family, pay for your expenses, pay for unplanned expenses such as medical costs? Do you have an emergency fund to ensure that if you're to lose your job, at least you have 6 to 12 months worth of income put away so that you're able to pay for your expenses? Do you have any investments? Are you using all of your income just on expenses? Are you putting anything away from your income? Do you have children that need to study further in university? What about your retirement plan? When last do you review that? When last do you have a retirement plan? So in terms of saving methods, very important, we need to know our spending habits. So a budget will assist us in ascertaining those habits and knowing where we're spending our monies. When it comes to saving, one needs to sacrifice the nice to haves. You need to get out of your comfort zone, set goals, and reward yourself when you meet those goals. The 3 steps to savings is your goals need to be specific, they need to be realistic, add a timeline to when you want to reach those goals, and reward yourself when you reach those goals. So both retirement savings and personal savings can exist and must exist. So your retirement savings should be done with your pre-tax income. So what that means is that you get your gross income, you then save some of that income towards your retirement savings, and then the net of tax income, that should then pay your expenses as well as then your personal savings. Tax-free savings account. So these types of investments came into play because it's government's response to encourage people to save from their after-tax income. So we are known as a country that does not save. So these particular investments came into play to encourage individuals to save some of their income. The benefit of a tax-free savings is that it is virtually tax-free. So all the income as well as the interest that is generated is tax-free. There's no capital gains tax. There isn't any dividend withholding tax. There is estate duty implications that we can assist you with managing when we set this type of investment. On an annual basis, the maximum contribution that one can make in a tax-free savings account is 36,000 per annum. A lifetime contribution is 500,000. There's no restrictions on access of the investment. There isn't, in most cases, there isn't any penalties when you access the investment. However, one cannot replace the amount that they've withdrawn from the tax-free savings. So there's quite a number of tax-free savings available in the market. They're in the form of endowment policies, through the bank, unit trust, and ETFs. So at Alexander Forbes, we do have a tax-free savings, very cost-effective and very cost-competitive tax-free savings that I encourage those who don't have tax-free savings investment currently to take up and make use of this tax-free savings to reach their personal financial goals.
Sizwe, I just have a question there. You said that there's no replacement of withdrawals. Say we are in October and I have put in the maximum of 36,000 into this tax-free account for the year. I then withdraw 10,000. And then when I get my bonus in December, I want to put it back in. Are you saying that it's not deemed as 46,000 that was put into that account?
Correct, correct. So what would happen now is that the amount over and above the 36,000 would be then taxed at 40%.
Okay.
And then which defeats the purpose of having a tax-free savings.
Noted. Does the whole then amount get taxed or only the additional amount?
The additional amount over and above the 36,000.
Okay, thank you.
Retirement planning. This is our core function at Alexander Forbes. That is to assist members afford their retirements when they retire. So as I mentioned, is that retirement savings as well as personal savings, they go hand in hand. It shouldn't be one over the other. They should actually complement one another, because in most cases, your personal savings should supplement your retirement savings. Just some interesting facts regarding retirement planning. There's less than 10% of members retiring will retire on enough income. Only 2% will retire comfortably. The rest of the members retiring will rely on family, the government pension, welfare, or will have to continue working well beyond retirement. Previously in the past, one would retire at age 65 and live up until age 75. But because of advancements in medicine, we now find that we need to plan for more than 30 years into retirement, because life expectancy has increased from 75 to over and above 80 to 90. So what that means is that you could need income for about 30 years into your retirement. Another crucial factor, main contributing factor that why most members don't retire comfortably is because when people change their jobs, they tend to cash out their retirement funds and start in the new job at zero. It is quite important that we now start putting certain financial habits in place. Retirement planning is very crucial. It should be an active approach. It shouldn't be something that you leave until 5 years prior to retirement. One needs to take an active approach. When last do you review your retirement plan? What are the projections saying regarding your retirement fund? Where will you end up the day that you retire on your retirement fund? Some more facts in terms of why a retirement fund is so important. The industry benchmark is to replace your salary of 75%. So this doesn't take into account commissions or bonuses. We always assume that when one retires, there wouldn't be any bond to pay off, and there's no school fees for children that one would be paying in retirement. Is having a comfortable retirement achievable? Yes, it is. If you contribute a realistic amount into your retirement fund and you continuously contribute towards your retirement fund throughout your working years. If you are contributing enough, what else can you do? That is your short-term savings. You can increase your short-term savings and investments, as well as settling of debt as soon as possible. Recent analysis shows us that 80% of people who withdraw from their retirement fund normally take their retirement funds in cash. This obviously has a result in members having a shortfall when it comes to their retirement plans and objectives. So what are the effects of not preserving? So this slide here shows us that there's two people. One member was contributing towards a retirement fund, and then they decided to cash out their retirement fund when they resigned or changed occupation, and they started from scratch at age 41. By the time that they're age 65, we then see the differences between staying invested or preserving your retirement funds up until retirement, as opposed to cashing out your retirement fund and starting from scratch at a particular time. So a question that I normally...
If I may, just on the slide before, just to emphasize that. So if you could just go back to the previous slide, and not just because at Alexander Forbes, retirements is our #1 focus, but I think to put this into perspective, and the numbers that have been used here are for illustrative purposes, you can see that the individual who stayed in the fund for the duration of their career gets to retirement with 18,000, according to these numbers. So call that 1.8 million or 18 million, depending on your salary range. The difference between 18 million and what happens when you restart at age 41 is 8 million rands. Because restarting at 41, you're ending at roughly 10 million, whereas having started at roughly 30, you're ending at 18 million. And that's almost double what you would have had just by staying in and avoiding the temptation to cash in. And I know Sizwe is going to elaborate on some of the many conversations that they have around this, but someone may feel that it's wise to cash out your pension so that you can settle debt, or to cash out so that you invest in a business. And no doubt there may be merits to look at some of those considerations at that point. But I think the key illustration here is the compounding benefit, again, of taking advantage of the financial system is what you lose out on. And this diagram in front of us just shows the magnitude of the difference between the two scenarios. Thanks, Cesar.
All right, cool. Thanks, Leroy. Yeah, so as I was saying, is that from time to time, we do get members or clients sitting in front of us that say, you know what, I'd rather cash out my retirement fund and then settle debt and then catch up, so to speak. So there is a decision that one needs to make, and that is the choice of settling the immediate debt as opposed to the long-term investment gains that you would have had you remained in that retirement fund. Another thing is that we tend to think that retirement is far in the future. You know, if I look at my circumstances, I'd say retirement is 30 years away. So I would say, let me rather focus on the now and the today as opposed to focusing on my retirement plan. Settling your debt now will mean that in most cases, you never make up the lump sum that you've accrued within the retirement fund. And that is due to the effects of compounding in the long term. So this table here illustrates that at a particular age, if you'd like to retire at age 65, for instance, and you start saving towards retirement, for instance, at age 20, you would need to put away on a monthly basis 13% of your income. The situation gets a bit more worse. For instance, at age 40, if you are retiring at age 65, in order to replace 75% of your salary at retirement, you would need to put plus minus 34% of your current income. That is plus minus about a third of your income, which in most cases, it's highly impossible to do that due to the fact that there are certain needs that need to be met with your income. So in conclusion, in your journey to a well-balanced financial life, you should remember the key concepts. Do not live beyond your means. Know how to manage your debt. Cash is king. Rather save and pay cash than to take on debt. Bad debt, that is. Get out of debt as soon as possible. It's never too early or too late to start saving for your retirement. Growing your wealth takes time. It doesn't happen overnight. Very important, include your family in financial planning so that they can model these solid financial principles in their own lives. Make your money work for you as opposed to you working for your money. Speak to a specialist. Put your plan into action. Speak to a financial advisor who can tailor your financial plan, show you how to save more money for retirement, and assist you in setting up a will that is executable. If you'd like to be in contact with me, at the bottom of the screen, that is my email address. You can pop me an email and we can schedule a consultation to better your financial plan and to put your financial plan into action.
Okay, thank you, gentlemen. Members, you can put questions in the Q&A or in the chat box. I would just like to summarize just some of the questions. Sizwe, in the beginning of our conversation, you spoke about ideally 30% of your income should be servicing debt. However, what is then the percentage, Stepa was asking, that we should be then putting aside for our savings?
So it's really up to one's personal financial plan in terms of what are their financial goals, what do they want to achieve in the long term. So once we first establish that, then we can establish how much of their income they need to put away towards their financial goals as well as towards their savings.
All right. And then, Mr. Monetsi, I'm going to throw this one over to you. The conversation of, and Sizwe listed a range of things that influence our spending, and you also mentioned including your family into the conversation. But is there a difference then between the reality of us Black members here of Black tax and family responsibility, financial spending? And is there a way to differentiate between the two in order for one to actually achieve their goals?
Yeah, I think the short answer again goes back to understanding your unique circumstances. So while yes, there are different pressures that may arise from Black tax or the unfortunate burden that we might find ourselves having to deal with because of a disability perhaps, or other circumstances that may befall you, like being retrenched from work. what is very key is to, again, I think the saying is tailor your dress to the cloth that you have, something along those lines. And in my experience, it then talks about delayed gratification, and in some cases just being blatantly honest with your circumstances. And like I mentioned earlier on, being brave enough and confident enough to say no, more often than not. The fact that you may not be able to enjoy driving the car that you dream of, or you may not be able to live in the neighborhood that you aspire to, or you may not be able to take your children out for dinner as often during the course of the month, is just how you simply appreciate your circumstances. Because again, Black tax is not uniform across the spectrum. It varies, and responsibilities are not uniform across the spectrum. Again, they vary. And as I mentioned early on when we talked about budgeting and planning, a lot of it does point to understanding your circumstances clearly, being able to focus on your situation, and then working through your situation as specifically and deliberately as possible. And where necessary, using professionals like Sizwe, or I think there's a lady in the chat who's also posted her details, Priscilla, to guide you through your specific situations, and then make the best decision around those trade-offs: more saving versus an insurance product, where to live comparatively in relation to what your earnings might be. But ultimately, it's so important to understand your circumstances and then work through to make the best decisions for your circumstances, rather than trying to keep up with the Mkizes or with the Joneses on the other side.
Yeah, sure. Elijah is firing away with a range of questions. I do want to highlight to members that one of the main topics for the year of 2022, was specifically in my portfolio, education and development, is finances. Because I've seen that this is a need. It's something that's taboo, we don't speak about. So during the course of this year, we are going to continue having these engaging conversations. But moving on to one of Elijah's questions is, as a startup in the financial literacy space, how can we access and get ourselves in a room with corporates to support the consumer education drives? Another question he asked is, how do we facilitate an environment for financial literacy to be internalized and actioned by consumers as well as us? Financial literacy is like eating healthy eating. Everyone knows they need to eat healthy, but not everyone eats healthy. Similarly, we know we should budget and invest, but we don't always do it. How do we change this and make financial literacy more practical? In your presentation, gentlemen, you spoke about, I know I'm paraphrasing, but almost accountability. So I know you kind of alluded to it right now when you spoke about Caesar and Priscilla, but how do we effectively put ourselves in a space where we move from, as you put, from bad habits to good habits?
Sizwe, would you like to take a stab at it, and then I can add?
Yeah, definitely. So I would say that financial literacy is a journey. I think we need to look at the grassroots. I would say that even the education system in our schools need to incorporate some level of financial literacy. You know, some of the things we only start learning when we start working. So I think it's quite important that at grassroots levels, we start promoting financial literacy, knowing things like budgeting, knowing things like, savings and investments, and so forth.
And to add to that, I would say it again goes to us translating this into simple concepts. And I like to say that it is very, very much our responsibility in our generation to set up the next generation, not just from a preserving generational wealth, but really to uplift our communities, our country, and the continent. Because I think what you do tend to find is certain environments across the globe have benefited from having having a better understanding of some of these mechanisms and tools, and they've been able to leverage the financial system far more than we are, perhaps as a continent. I think there are European countries where their pension coffers are so big, they are able to pay people who don't need to be paid, just because they've got to utilize the money that has been preserved and accumulated over time to deal with basic services and other requirements that the population may have. And no doubt, of course, that translates into lower taxes and other benefits that help the citizens of those countries to have far better lifestyles than perhaps what we are enduring in our situation here. But without us getting bogged down by the fact that our salaries may not be high enough or that our tax is too high, it is important for us, as Sizwe says, to look at the grassroots, spread the word, live by example, and more importantly, focus on the small steps, because those small steps progressively over time will translate into the big change and the big impact that we need to see. And no doubt, there's a big opportunity for us from a financial literacy point of view. And as individuals and collectively as an industry, I think there are more and more signs that we're looking to work together to progressively improve the profile of South Africa from a financial management point of view.
Yeah. There was a comment question. I'm trying to find it right now, but I remember that this was from much earlier on in the session, and I really wanted to leave it for this point. You did speak about that it's never too late, and someone just, thank you for being vulnerable, shared on, but what happens if you're, I'm now paraphrasing, making it general, what happens if you're so consumed with debt, your credit score is low? Is there a point, to come back? Should they even consider debt review? And what are the consequences of debt review? Because I know that is never really spoken about. It's just like, oh, you've got an option for debt review, but no one really talks about that bad side. Do we go debt review, or do we be patient, even if it takes us 5-10 years to get ourselves out of our situations?
Yeah, thanks for that question, Tobera. So I normally encourage members to try and get themselves out of that situation as much as possible. Worst case scenario, if we cannot get ourselves out of that situation, then approach the debt review specialist. Yes, there is a negative impact on seeking debt counseling on your credit score, but it is slightly better than being blacklisted. So if you can, get yourself out of that situation. If you can't, worst case scenario, then do see a debt review specialist to make an alternative plan for you.
I would hazard to say it's materially better by comparison to go through the debt review, as negative as it might be. It's materially better than being blacklisted, because the burden that comes with being blacklisted and having failed to manage your debts or your obligations can affect you across a wider range of circumstances, be it getting a job in certain environments, or then down the line, how long you need to wait to be able to get back into the system. And no doubt there's the analogy of the snakes and ladders game, where across the board, as you go higher and higher, the risks of falling back down to the bottom also become more pronounced. And hence, in some cases, you'd almost say, fail fast, try things and learn your lessons much earlier, so that the further up the ladder you go, or the further up through life you go, you are not as susceptible to some of the challenges that do present themselves. Because yes, when you look at it on the face of it, the implications of being under debt review might be X number of years that you need to deal with those specific limitations. But in the greater scheme of things, if you are dealing with that earlier rather than later, perhaps you are dealing with that before your obligations to your children and putting your children through school have grown materially in comparison. And hence, I think, again, very important to approach the professionals, approach people like Sizwe and Priscilla, who by and large give this advice for free. And the industry is engineered in that way for us to be able to access a lot of this information. And it is very unfortunate that most of us don't realize that, and only then have to deal with things reactively. I think for us at Alexander Forbes, we get exposed to the fact that so many people don't realize what their employee benefits mean. So even this evening, when we were talking about putting away money for retirements, in most organizations, depending on your pension fund or the umbrella fund that you're in, or the provident fund that you're associated with, there are insured benefits which give you access to certain insurance benefits or products, which are not always obvious. Some of those cover things like funeral or death, disability cover, which you may find with a better understanding, you can then again make better decisions around how much you invest in insurance from a standalone point of view, or how much you invest in other savings infrastructure, or how much you save. Because with better knowledge and better understanding, you'll then make sure you avoid being over-insured in certain respects, or simply just understanding and comparing where it makes more sense to put your money, so that again, you manage and protect it better than you may if you were not as informed.
Thanks for that. I just want to go back to a previous question of Elijah's. I think I read through it very quickly, and I just still want to give it justice. When he asked, like, as a startup in the financial literacy space, how can we access ourselves in a room with corporates such as yourself, Alexander Forbes, to support your drives in consumer education? Is there an opportunity? Does A Forbes offer such consumer education drives?
So at Forbes, we do to an extent, and I think it varies from organization to organization. And us at Forbes, we've got a trust that we've set up, which a lot of our social investment is channeled through that trust. But I would say, as an initial approach, there are industry organizations such as ASISA, the Savings and Investments Association of South Africa, where you could approach them with your solution and perhaps partner with them. And in many ways, they could give you access to other organizations or institutions where there is an appetite, or at least a declared prioritization of what you are looking to do. So you'd find that by working through the Banking Association or the Insurance Association or ASISA, as I've mentioned, you may then identify other industry players who are prioritizing what you are doing or are more open to supporting that. And I would say, hence the opportunities to canvas some of those associations. But yes, at Alexander Forbes, I'm not privy specifically to that specific focus area, but no doubt we can be in touch, and I can try and help and check and investigate that as an opportunity for you, Elijah.
Yeah. And then from our side as BMF, Elijah, you'll see Sukumzi has posted a membership link. As I have mentioned, that this is one of the key priorities for the year of 2022 at BMF. If you become a member, you'll be alerted as well to when we'll be having more rooms such as this that you'll be able to get involved in. There will be both virtual and physical, where you'll be able to meet people and engage in person as well. As we wrap up, merging these two questions into one, would you say financial literacy is the top topic for South Africa? And your top 3 tips for someone starting up in the financial literacy space? Okay, Sizwe, would you say that the most the most important topic for South Africans today is financial literacy?
Definitely, I would. Financial literacy has an impact on all spheres of our lives. So we really need to have an understanding of certain financial concepts in order to grow financially. Definitely, I would.
I would echo that. And in my view, I think our biggest challenge in South Africa is inequality. And inequality is measured through financial means or the lack thereof. And hence, financial literacy is a very, very important ingredient to helping to address the big issue around inequality. And yes, I think there are civil actions that we could take, there are political actions that we could take, but at a personal level, there are financial actions that we can take to contribute to our progression upwards across the on the financial spectrum, and hence having a better sense of understanding will help you in that regard.
Okay, and then Mr. Monetsi, of course, the second question has to be for you with your extensive experience in the financial services industry. What would be your top 3 tips for someone starting up in the financial literacy space?
So I would look at it, and I guess top three points would be, firstly, if you look at it internally, so look at who you are and what you have. So what is your personal balance sheet? What are the assets that you have? It could be your qualifications. It could be quite specifically the job that you have and your earning potential. Look at that, understand that, and make sure you're making the best decisions that you can in that space. More externally, as a secondary point, I think you would find that whilst there are superstars who are recognized for being great at sports or great in business, they surround themselves with knowledgeable and complementary teammates, colleagues, coaches. And so I think as a second point, it would be to be open to getting help and soliciting support to leverage the experiences of others or the knowledge of others. So once you understand yourself, you plug into the opportunity to benefit from others and the skills and expertise that are out there to complement and build on what you have as your goals or your visions. Then lastly, I would then look to say, identify what comes naturally to you. So be it around understanding your passion and your purpose, and then using that to catapult your journey forward in terms of managing and protecting the value that you have. I think by having that clear vision around who you are and what you want to be and why it matters, it will possibly influence the decisions that you make around money, because you have a clear vision about where you want to get to. You might not buy that VW Polo right now. You will first start with a Hyundai i10 and then progressively work your way through to the VW Polo down the line.
And then to the 4 rings.
Oh, yes. Absolutely.
Absolutely. We could speak so much on this topic, and I know someone mentioned in the chat group that this is almost like a lot of information, and I think I should have mentioned in the beginning of the session that take out your notebooks and your pens and write this down. So there was someone that asked, will there be a recording? And yes, there will be. If you just follow BMF Sandton account on our LinkedIn, Twitter, Instagram, and Facebook, as soon as this will be ready, it will be shared. It will also be shared on the BMF Gauteng YouTube channel. So you always have an opportunity to come back to this conversation should you feel stuck. Thank you so much for joining. Thank you so much, Leroy and Sizwe, for engaging in this conversation and educating us. Good night, everyone.